Good afternoon. My name is Cormac Kelleher. I'm the International Tax Partner with Mazars in Ireland. I'm joined by my colleague, Mairéad Divilly, as well today. Mairéad heads up our AOS offering, so we look after outsourcing for Indigenous Irish businesses all the ways up to large listed multinational organisations. So we're delighted to be here today with Iconic speaking to you, and thank you to Christina and Saoirse for organising this event. The hard part is always kind of getting people to attend these things. So thank you for all that work. I suppose just to kind of before we set the scene, you're probably wondering who even Mazars is, or as some people say, Mazars. That tends to be our American colleagues. So Mazars is actually is probably the mid-tier accounting firm in Ireland. We're probably number 5, number 6 in terms of accountancy firm sizes, depending on which league table you look at. We have approximately 500 people in Ireland. We're based in Dublin, Limerick and Galway. And like I said, I'm on the tax side and Mairéad heads up our outsourcing offering. So when we were speaking about this a number of weeks ago and we're looking at different topics, the question of tax is often something that people find very difficult. They find it very challenging. And unfortunately, it's one that tends to put a lot of people to sleep. So what we're going to look at when we're looking at the idea of the topics to be covered, we were looking for a topic that was current, that would affect people themselves, and that people would have an interest in. The one that we felt was this particular topic here about the remote working. So I think it's fair to say remote working is something that was foisted upon a lot of organizations back in March 2017. So we're trying to pull together the topic, and this was the one that we said people working remotely. And we've seen a lot of situations where people that might have been based in Ireland decided to relocate to their home countries, or maybe just warmer countries for short periods of time. We've equally seen scenarios where people that they decided to move to Ireland for short periods of time, maybe to be back with family. And all of this was very reactionary. People just did it. People didn't really necessarily think about tax. Rightly or wrongly, it might have been assumed that it was going to be only for a few weeks. So what we're looking at here now is the implications of all of that. Where we're actually seeing another fallout of all of this is how it impacts corporation tax. It's one that hasn't necessarily been thought about by a lot of companies. And it's only now that people are starting to think about, having employees in Ireland or having the Irish company having its employees in France or Spain or wherever that may be. We're also going to touch on some payroll considerations. So I suppose general stuff, nothing to do with COVID or anything like that, but it tends to be kind of more areas where we see employers get it wrong, and that it's how there's common pitfalls in the operation of payroll and how things get taxed. I suppose the reason we put it up there again is if you look at things from a risk perspective, if something is wrong from an Irish corporation tax perspective, the downside from a tax side is 12.5%. If it's from a VAT perspective, it's 23%, the VAT rate. If it's wrong from a payroll perspective, it's possibly 52 to 55% of a tax exposure that you're dealing with. So usually when we'd be talking to clients about stuff like that in terms of risk areas and areas to focus on, we would tend to front load the payroll side of things, because if it's wrong, it's very, very wrong. So if you maybe move on to the next slide there, Christina, if you wouldn't mind. So the first area we're going to look at is the scenario where an Irish employee, so this may be someone that has been working in Dublin or Cork or Limerick or whatever the case may be, and they decided to relocate to their home country. Or like I said, some people might have decided they wanted to move to Spain or somewhere like that for a period of time, or Dubai, because cost of living, change of scenery, etc., etc. So maybe if you just move to the next slide there, Christina, again. So we have a number of different scenarios here, and apologies for all of the text, but as you can even see from just the amount of text there, it's quite broad in terms of the potential amount of issues or areas that we need to consider. So I suppose the first scenario that you could look at is where you have an individual who is not resident in Ireland. So a not resident is basically a person who is not spending more than 183 days in a tax year here. This individual works mainly outside of Ireland. So they packed up their bags and they moved to Spain or Dubai or somewhere like that. And they're only carrying on incidental duties in Ireland. Now, incidental duties, that means they come back maybe the odd time for a meeting or something like that, but the amount of journeys back is very, very limited. The starting position in that scenario is because the person was on the Irish payroll, because the person was liable to Irish PAYE, the person stays under Irish PAYE in that scenario, even though they might be in France, Spain, Germany, okay? The exception to that is if you have what's called a PAYE exclusion order. So a PAYE exclusion order is a specific document the company, the Irish employer, needs to get from Irish revenue. If it does not have this document, you have to stay on the Irish payroll. Now, again, what we've seen with some employers is they've taken the position that, well, this individual doesn't work in Ireland, they're carrying on the duties of their employment in France, in Spain, or wherever it is now. Sure, why is there Irish tax? Well, the reason there's Irish tax is you haven't got the PAYE exclusion order. The downside is that if Irish revenue came in, they asked and say, well, show me where all your employees are. We noticed that these 10 individuals were previously on the books, on the Irish books and paying Irish tax. Why are they not paying Irish PAYE in 2020 or in 2021? If you can't produce the PAYE exclusion order, there's a risk that Irish revenue would say, well, you should have operated the tax and we'd like 52% of whatever you paid them, okay? The other side of that is that just because you might have your PAYE exclusion order, you could end up in a situation where you're not paying Irish payroll tax here in Ireland, but the person is an employee exercising the duties of their employment in France, Germany, Spain, wherever the case may be. So the question then is, well, does the Irish company now need to register for payroll taxes in that particular country? And I think that's one of the issues that we're seeing with a lot of clients is that they didn't necessarily look, or they didn't consider, or they didn't think through the possibility that, you know, agreeing to let employees work in a different country for a period of time, that, you know, that you might suddenly start triggering local issues. So it's all very well and good to be able to say, well, you're paying your payroll tax in Ireland on this individual. That isn't going to be an argument that you're going to be able to successfully give or successfully sell to the foreign tax authority. They don't really care. All they know is that you have an employee on the ground working in your country and you fall within the scope of the requirements there. The next scenario that we have there, again, we have the individual non-resident in Ireland, but they are working in Ireland and in the other country. So this could be a scenario where an individual works maybe 2 days in Ireland and say maybe 3 days in London or something like that. So they're continuously hopping back and forth between the two different jurisdictions. In that scenario, what we would typically see is that you would end up having to pay payroll taxes in both countries. Now, the person's going to say to you, well, I only have one contract, and you know, my contract says I earn 60,000 euro, 70,000, whatever the number is. What you're going to have to do in that scenario is you're going to have to look to see how much of that 60,000 is going to have to be taxed in Ireland, how much is going to have to be taxed in the UK. Usually the way that you would look at doing that is you would look at the amount, or the typical amount of the time that the person spends in Ireland in the UK. So that could be two fifths of the figure here and 3/5 in the UK. So that tends to fluctuate, as you can imagine. And again, you're going to have the challenge there of trying to be able to explain to the Irish tax authorities, or we'll say it's the HMRC in the UK, the appropriateness of coming up with that 2/3, 2/5 and 3/5 split. So the fourth scenario third scenario we could have is what if the individual remains Irish tax resident. So maybe they're living here, their family's based here, but they go abroad for chunks of the week, for example, okay? So they're working outside of Ireland and they're suffering foreign tax. In that scenario, just because the employee might think that they pay their payroll tax in the other country, because they live here, because maybe their family is based here, their home is based here, they can still end up in a scenario where Irish tax is required to be paid here as well. What you could actually do possibly in that scenario is that you'd actually have two payrolls being run at the same time. You'd have the Irish payroll and you'd have the foreign payroll. And what you can actually do then is you can apply to revenue and you can get a credit for the foreign tax to be offset against your Irish tax. And if that's done properly, you can actually get that done on a real-time basis. If it's not done properly, well, what you're going to end up in a situation is that the person is, say, earning 70,000. They're paying tax on the 70,000 in, I don't know, Brazil, pretend, and they're also paying tax in Ireland on the 70,000 at the same time. And they're having to fund two tax bills. That's hardly a good scenario to be in. So there's a little bit of work, a little bit of thought that needs to be put into that. The other issue that's there, and I think a lot of people are tending to forget at the moment, possibly because I suppose it's not on their radar, pensions. Okay, so it's all very well and good to talk about, I suppose, the pure PAYE element, but as we all know, when we look at our payslips, we have PAYE and PRSI, or PRSI or social security. So our social security contributions are what we, I suppose, contribute or pay over the years. And that's what's going to give us our entitlement to get our old age pension, as we'll call it, and all the other state benefits that go with it. So you could end up in a situation that you are not necessarily contributing to your PRSI, depending upon the jurisdiction that you're based in. So that could be bad from I suppose, a records perspective from an Irish side. So you could end up that it not only could you have a tax issue today, but it could also mean that you could have underfunded your contributions. So again, there are ways of getting around this, depending upon the countries that the individual is going to. If they're paying tax there are reciprocal arrangements between some countries. Now, when I say some, it's a very short list. Obviously, Europe would be on that list, a lot of those jurisdictions. But if you're, say, maybe going to kind of, say, Canada or maybe Europe, South Africa or somewhere like that, we don't have the reciprocal arrangements there. So you would have to look at, is it possible to make voluntary contributions in order to keep your pension records up to date? So that's just something to look at as well. Again, I'm not sure, depending on the audience here, you could be the company, so you could be wearing your HR hat, or you could be looking at this from the employee perspective as well. So I think depending on which hat or who the audience on this is today, if you are the HR person, I suppose really you'd want to be looking at this from a HR side in terms of if there are voluntary contributions to be made, well, who pays them? Is that a bill that's going to be picked up by the company, or is that an issue that the employee needs to deal with themselves? And I suppose then, if you're looking at this from the pure employee perspective, well, you need to be aware of what your obligations are, and you need to be aware that what you're doing today, does it trigger a tax obligation in the other country that is a purely personal obligation that you need to deal with as opposed to your employer. So lots of things to think about. It isn't, unfortunately, as simple as buying a Ryanair flight. So there's a lot of things that need to be thought through from a practical perspective, and there's some immediate issues and some potentially longer term issues there as well. Let's go on to the next slide there, Christina. So the other scenario that we could have as well is where there's inbound employees into Ireland. So this is maybe, I suppose, just the opposite of what we just covered there a moment ago. So this is where maybe the employee is an employee of, say, a UK company. They have traditionally worked in the UK, but they've decided, due to flexible working environments, et cetera, they have decided to relocate back to their family home in Ireland. So if you just go to the next slide again. So in that scenario, we have a couple of things that we need to look at, and it's probably the bit in the middle that we're looking at there. We need to look at the difference of whether an employee is on an assignment. So are they kind of sent here? Is it kind of more of a longer term thing? Or we're looking at the situation of where there's short-term business travel. Now, depending on which one that we're going to be looking at, there are different rules. There's different exemptions. Let me go to the next slide. The other element that we need to look at then as well is we need to know where the person is coming from. So we're saying, is it a DTA? Now, DTA stands for Double Taxation Agreement. So we need to know, does Ireland have a double taxation agreement or not with that country? If you're looking, if you're really bored for the remainder of your lunchtime, you can go onto the Revenues website and you will see, if you scroll down to the very, very bottom under Tax Professional, the box down there, you'll find all the double taxation agreements. We have about 72, 73 double taxation agreements in place at the moment. So again, you can kind of guess the ones we have. We're well covered across Europe, US, Canada, a lot of the Asian countries. Where we're really badly covered, and there's work ongoing at the moment, is a lot of the African jurisdictions and a lot of South America. So we've very, very bad coverage on a South American perspective. So if there was a person kind of, maybe they had traditionally been on the payroll of a multinational, we'll say in Brazil, and they were relocating back to Ireland temporarily. Brazil, we do not have a double taxation agreement with, so you'll be a non-DTA jurisdiction. Let's maybe go to the next slide. Now, everything here when it comes to employees coming into the country, it's all down to days, right? Now, the thing with a day is any part of a day. So, you could be literally kind of here a minute to midnight type of thing. That one minute will constitute a day. There used to be a kind of the rule before, like the midnight rule or the Cinderella rule, as people used to call it. That no longer applies. So once upon a time, people, would be very eager to be on a flight at 11 o'clock at night to get out of the country. If that happened, it didn't count. But whether you're arriving in Dublin Airport at 5 a.m. or you're arriving at 11 p.m., that still constitutes a day. Now, looking at this scenario where a person is in the country for less than 183 days, we've broken it down into different categories. Now, where you're going to find this, if any of you are accountants, you are not going to find this in the tax legislation, okay? Where you will actually find this is it's in a tax and duty manual. So it's kind of a precedent document that the Irish Revenue Commissioners have published, and it's all laid out there. But like I said, it's not in the legislation. What they look at, I suppose the first scenario you have is where the person is in Ireland for 30 work days in the tax year. Now, this is 30 work days in totality. It's not 30 and you disappear and then the clock restarts again. It's 30 work days in a tax year, and our tax year runs from January to December. If the person is coming from a DTA jurisdiction, so we'll say the UK, there's no Irish PAYE obligations, and this is provided the double taxation agreements conditions are all satisfied. Broadly the same answer for our non-DTA. So this, for example, will be kind of the typical position that we would have had, when people were back flying and everything, say a year or two ago. If you had, say, people coming in from India, coming in from the US, wherever the case may be, they're coming in for a board meeting, they're coming in for, sourcing customers or something like that. And they're going to be here maybe 5, 6, 7 days in total in the year. They would have been falling in under that, so there'd be no issue. The second scenario that we have is where the person is between 30 and 60 work days in the year. Again, for the DTA scenario, we have no PAYE obligations, again, provided all the DTA requirements are satisfied. Now, that's a kind of a sneaky one, because if you actually look at all the list of conditions that need to be satisfied, it's a very, very long list, and you could potentially trip yourself up, right? Depending on what you do from a pure accounting perspective, and depending on what you do from a pure corporation tax perspective. So I suppose like the caveat or the kind of the health warning that goes with it, pull out the conditions. You need to make sure that the HR people are talking to the finance people in that scenario, because you could fall afoul and then suddenly pull yourself into the PAYE for that 30 to 60 band. For the non-DTA scenario, if a person is here 31 days and they're non-DTA jurisdiction, so again, Brazil, then they're within the scope of PAYE. Now, again, the way this works, it's the difference between the first band and the second band. it's not that one day suddenly comes in, it's everything, right? So the clock basically resets that if the person is here 31 days, all the previous 30 days suddenly get pulled in. So you would see with some clients as well that they'd be very, very conscious of tracking the number of days employees are in the country and making sure that there isn't a bit of creep going on there, that suddenly everything gets pulled in. And so they'd be making sure they're gone on day 29. And there might be a new team brought in then, and the clock restarts. The third scenario is where they're between 60 days and 183 days. The non-DTA, again, there's a PAYE obligation from day one. But for the DTA scenario, there's a PAYE obligations in the absence of getting a PAYE dispensation. So it's again, we just need to look at the specific rules there as well. What we would be saying to clients on this, sometimes I suppose there might be, depending on the size of the organization, there might be a bit of a disconnect between HR, between HR, between finance/tax, and I suppose the team, that maybe the sales team or kind of the engineering team, depending on the organization. And sometimes we'd be told, oh yeah, there's actually 5 employees in Ireland and they've been there for the past 2 months, and you're only finding out about it now. And the different divisions wouldn't necessarily talk to each other. So I think there's maybe an internal education element that's possibly required, so that at least if someone finds out that, you know, there's a team going to be going to Ireland in this scenario, and they're going to be there 2 weeks, 3 weeks, 4 weeks, well, what does that actually mean, or what does that actually look like? And at least they're different people talking to each other. So at least you can take some action, and you could say, well, look, which category are they in, or you know, and do we have an issue? Maybe go to the next one there. This scenario is where we're in the country, or the individuals are in the country for more than 183 days. This is quite simple, irrespective of whether you're a DTA or a non-DTA scenario. Irish PAYE obligations apply. A bit like the other example there, it applies from day one. So this can be kind of quite problematic. So especially when you have contracts, say like building contracts or something like that, that, you know, you kind of start off life and you're kind of work out the project and you're saying, oh, it's going to take, you know, 160 days or something like that. And you think you're fine. But maybe there's delays with materials, you know, kind of other kind of weather delays, whatever the case may be. And the contract suddenly takes 200 days to complete. In that scenario, the employees that would have been here for 200 days, they get fully pulled in. So it can be quite expensive, because you can imagine in that scenario, you're suddenly having a PAYE obligation on that pool of employees, because they're all within the scope of Irish tax. Usually what we would see is you can't necessarily turn around to the employee and say, oh, by the way, you also owe tax in Ireland, plus interest, plus possibly a penalty because you didn't do it properly on the first time. So you can't really say that, because suddenly you're going to have a very disgruntled workforce and you'd like them to work on the next contract. So usually it's the company that has to pick up the tab, okay? And if they pick up the tab, well, that's just eating straight into your margin and I suppose the overall profitability of the contract. So it's something that needs to be monitored with great care, because like I said, otherwise you mightn't be going for a second go at the next contract, or the phase 2 of the contract. Maybe pop to the next slide, Chris. Yeah, great. So as I said, people, I suppose, have started to slowly start turning their thinking to, you know, I have employees, they're either, you know, after relocating to a different country, or they're after kind of going from abroad into Ireland, as the case may be. And the initial thinking, I suppose, a lot of the people have had has been more around the payroll tax side of things, and rightly so. It's only, I suppose, now that people are starting to kind of raise the question, or saying, well, is that it? And the answer is no. Like with tax, there's always something else. And one of the areas where we're starting to see this is on corporate tax. So maybe go to the next one. So with corporate tax, we have this concept of permanent establishment. So permanent establishment is kind of a fancy name. It's a tax name for a branch, okay? Now, again, I suppose the branches, you can have different ideas of a branch. You have a branch from I suppose, a colloquial expression that it might be treated as a subsidiary. There's a branch from I suppose, a company law perspective, and that's a very specific definition. But the branch from, I suppose, a pure corporation tax perspective is that you could literally just have people on the ground working, right? There might be no formal office. There might be no, you mightn't have, rented space. You mightn't have registered anything with the company's office or anything like that. But the fact that you have people on the ground doing work in Ireland, and you want to be concluding contracts, maybe they're sourcing customers, doing lots of demonstrations of projects, all this type of stuff. That in theory could actually trigger what's called a permanent establishment. Now, if you have what's called a permanent establishment, your next question or problem that you have to deal with is, well, if it's how much profit do you attribute to this? So say, for example, you had a scenario that you had an American company, and the American company has a sales team kind of going around Ireland, pretend, right? And that sales team, they're all employed by the US company. They're coming over for, throughout the year. They're not based here, but they're coming over regularly, we'll say. And they're meeting different customers or potential customers. They are kind of, substantially concluding all the contracts, all this type of stuff. And they're performing their functions here. There is actually an argument that there is a corporation tax presence here. So then you'll be saying, well, how much profit do you attribute to Ireland? So how much 12.5% corporation tax do you pay? So it's quite a big thing. So where this is relevant now is, imagine you are a technology company and you've traditionally based in your offices here in Dublin or wherever else in Ireland. And suddenly you have a lot of your Irish employees based in Germany, Spain, Portugal, all these places. They're all doing the work they would have done before. It's all very valuable work or high-end work, we'll say. So they're performing the duties of their employment there. Well, from a corporation tax perspective, there's a question mark that, do you have to attribute a profit because you have 5, 10, 20 employees now suddenly that decided they all wanted to relocate to, Poland or Romania or wherever it is. So it's another big question. In terms of, I suppose, looking at this as well, the amount of profit that you would tend to have to look at, it tends to be associated or dependent upon what these employees are doing. So it's what role, what function are they undertaking? So is it a very high-end value-adding role, or is it more of a low-end back office support function? So you need to look at that. There's also, I suppose, depending on the country that the employees are potentially in, you might have a double taxation agreement between Ireland and them. And if that is the case, depending on the treaty, there can be carve-outs or exemptions. So you might be lucky enough to land yourself within the scope of one of those exemptions, and there might be a non-issue. Maybe go to the next slide. So I suppose if you kind of look at this from a COGS perspective, the bits where, because of what the employees are all after relocating, you need to, in terms of the value add or the value attribution, that's the transfer pricing side. So once you've identified what they're doing and where they're doing it, is there a transfer pricing issue in terms of the value attribution there? From a VAT perspective, again, depending on what the employee is doing in that particular country, you might have what's called a place of supply from a VAT perspective, okay? So if the employee is maybe in a particular country, they are making the sales, they are doing all the deliveries from that country or something like that, in theory, that's a place of supply from a VAT perspective. So you might end up, the Irish company might need to register a VAT in the foreign country as well. And the withholding taxes, again, depending upon the country that the employees are after going into or basing themselves in temporarily, there might be kind of local rules about capital controls and the amount of money and so forth that you can take out of the country. So quite broad, right? So what are we seeing again happening in practice? What we're seeing now, and when I say now, this is kind of only kicked off in, say, January onwards, these type of questions are coming in. People are now kind of saying to, liaising with the HR team going, right, where are the employees, right? I thought they were all sitting in Ireland. And it's only now that they're starting to discover, well, actually, there's 10 people here and 5 people there and so on and so forth. And they're now trying to understand, right, if we have that team there and the requests are coming in going, they want to stay there permanently. If we let them stay permanently there, what is the issue from a payroll perspective? Do we need to register? What are the costs? What are all the practicalities that go with it? If we can get over that, well, what's the issue from a corporation tax perspective? Do we have to file returns? What's the cost of doing that, et cetera, et cetera? So what we're seeing is sometimes the answers to these questions can be so complicated in terms of the amount of compliance, the cost that goes with doing all this extra compliance, to facilitate a certain number of employees. It becomes punitive. And companies are saying, well, look, we can't, right? You're either coming back or that's it. And other times they're saying, well, look, you're such an amazing employee. I know it's expensive, but we'll deal with it and we'll bear the cost. Let me go to the next slide. So sorry, I'm just conscious of time. So the other one, I suppose, just to kind of shift gear for a moment in terms of payroll considerations. I mentioned there at the beginning, my colleague Mairéad Divilly heads up our AOS offering. And one of the offerings that's included within that is our outsourced payroll offering. So we'd look after the payrolls for, I don't know, lots of small companies, but equally we do ones that where there's 500, 600, 700 employees per week that they have to get paid. So you can imagine we see absolutely every type of scenario and issue and things you couldn't even dream of suddenly starting to appear on payslips and queries. So what I've done is on the next slide, I've just kind of pulled together some of the more common things that maybe need to be thought about. So there's the old chestnut, what is the person? Is the person an employee or is the person self-employed? It's only, I suppose the difference is, well, if the person is an employee, well, then you have the obligation to operate all the payroll taxes. You also have the obligation to pay employer PRSI, and that is about 11% at the moment in Ireland, okay? So, it can be very beneficial or attractive for the company if the person is treated as self-employed. Now, the reality, though, is when revenue would come in and look at this, it doesn't matter what the agreement that you have or the contract that you have with the person is or says. If the reality is that the person is under your control, the person only works for you, they get a fixed amount of money every week or every month or whatever the case is, you can call them self-employed as much as you want, but the reality is they are an employee. So what we would see again with some other companies is they would have individuals that they call self-employed, but it's only when you start digging into it, they're really self-employed. And there's they're self-employed, but in reality employees. So there's a huge potential issue there. Where this issue really comes out is, I suppose, is one of two scenarios. Revenue either come in to do a revenue audit and you have a problem. So you have 52 to 55% tax plus all your interest and exposures. Or the other scenario is you're looking at selling your company. So I know if I was the purchaser, I'd be saying, well, give me a list of all the self-employed people you have or the contractors that you have in every single country. And I'd be going down through it and say, no, they're employees. You should have operated the thing. There's a payroll tax exposure and the exposure is X amount and we're going to knock it off the asking price. Okay. So even, it's going to hurt your back pocket in some way or the other. The other area we'd see is benefits, and I just kind of put two kind of sub elements there would be the share schemes and the salary sacrifice. So with the share schemes, in Ireland, we have very, very specific rules around share schemes. What we would see again with some clients is, maybe the share scheme was set up by the Irish or the US employer, it was set up by the US group rather, maybe the Israeli group, the German group, whatever the case is, and they've just basically done a copy and paste of that to apply to the Irish market. Doesn't always work, right? Depending on how it's structured, you could end up in a scenario that you thought you were being nice and giving the employees these, the ability to participate in the share scheme, but you could actually walk them into an immediate tax bill and they've no money to pay it. So we'd always recommend that before you enter the share scheme or roll it out for the Irish market, get it looked at in the context of the Irish rules. because what you thought might have been a good news story might not be appreciated by the employee. The salary sacrifice is another one where you are again trying to be too nice and you're saying, well, look, I 5,000, I can give you the 5,000 whatever way you want. I can give it to you in pensions, I can give it to you extra days, holidays, whatever, right? With that scenario, if you give the employee the right or the ability to pick and choose how they are remunerated, well, that's a no-no, right? In that scenario, if the employee has the ability to pick and choose, you basically say the 5,000 in my example, that is all liable to PAYE, PRSI, USC, right? So just watch where you'd see some companies have what's called flexible benefits package, and you have like, I suppose, notional money that you can play around with. If you have that scenario, you need to look to see, well, how does that actually flow through to the payslip? So we've seen ones before where something nice, very badly done, and it came up in a revenue audit. Expenses, again, there's very, very strict rules by the Irish Revenue on the payment of expenses to employees, the records that you need to maintain. Again, sometimes, unfortunately, we'd see employers pay round sum expenses to employees, maybe €20 a week or something like that. In that scenario, that €20 is deemed to be a net salary payment. It gets grossed up by revenue, and you, again, the employer, are going to have to pick up all the tax on that. So maybe just look at your expense policy and the procedures and so forth that go around there. Because again, I know if I was doing a due diligence, like a purchaser due diligence, I am pretty much guaranteed to find errors when it comes to expenses. And it tends to be a big number. And I suppose then just the final one, kind of tying back into everything we were discussing this morning, is, well, where is the tax being paid? So where are the employees? Where are you paying the tax? Is it in the right country?